Have you ever wanted to ask a real estate investor how real estate investing works? Well, you're going to get a chance right now with the top 10 questions that I get asked as a real estate investor. Let's go. Welcome in. For those of you who don't know me, I'm the Hardy Investor. I own 72 rental units that make over $15,000 a month in monthly cash flow. And these are the top 10 questions that I get asked as a real estate investor. All right. How can I earn passive income through real estate investments? Well, that's a loaded question. Number one, follow my channel, The Hardy Investor. We can go all day on this, but the number one way to earn passive income with real estate investments is to find cash flowing property. Cash flowing property means that the income minus the expenses results in a net gain every month of cash flow. That's the best way to earn passive income through real estate investments. Now, one thing I think people should know is that in order to get into cash flow in real estate, you typically need to either have a lot of capital or know people that have capital. So you could either go earn money that you then invest in cash flow in real estate and continue to earn money that you continue to pour into cash flow in real estate, or you can develop the skill of raising money and bring lending partners to bigger deals. That's how you could have value. That's how you could have stake. You could generate these deals yourself, but the real value that you could bring if you're not bringing capital is usually, can you find the deal? Can you find the funding? And then can you manage the property well? Fix it up, manage the tenants. Doesn't mean you need to do it all yourself. You can put the pieces together for this, but that's one way that you can go out and do it even if you don't have the capital. All right, number two, what are the things that we need to avoid when it comes to real estate investments? Oh man. I would say doing your due diligence is huge. So one of the things that you should avoid is trusting that everybody else has just got the accurate numbers for you. So avoid relying on other people to do your due diligence. Now, it's important to have people on your team, like inspectors, maybe people that can help you analyze deals together. But if someone brings you a deal and they're trying to sell it to you and they're like, hey, here's the amazing numbers that this property has, don't just trust what they say. I mean, you do have to trust to a certain point, but never get an under contract without doing your own due diligence. And especially never go past the due diligence period of your contract without performing all your due diligence. So that's the biggest thing is real estate investment's great as long as you're doing your due diligence, and that means inspecting the properties but also analyzing your own deals. All right, number three, what are some key factors to consider when evaluating a potential real estate property? Oh, hey, perfect. This goes hand in hand with my previous question. So number one, you want to know what kind of income can you make from the property. So that's usually your rents, but maybe you're doing short-term rental, maybe you have laundry on the property if it's a bigger property, maybe it's a storage unit and you've got different ways that you can generate income. What income are you going to make on the property? And then what are your expenses? So property tax is a big one, insurance, utilities. And then you've got management, because even if you're managing yourself, you still want to build that in so you can either pay yourself or hire a manager in the future. You've got maintenance on the property, so ongoing expenses to take care of the property. And then you always want to have a vacancy rate built in, because no matter how good you are keeping your units filled, there's always going to be some level of vacancy, even if it's just turning over from one tenant to the next. Those would be the key factors to look at when you're analyzing an investment property. And then of course you want to look at the purchase price. So what's your funding going to cost you if you're either paying cash or if you're getting a loan from someone? How much is that going to cost you every month based on the purchase price? All right, number four, how do tax incentives affect investments in real estate investments? Real estate is one of the best vehicles to own for tax incentives. So first of all, you should always consult your accountant in your local area, but you can depreciate a property every year. In residential, it's 27 years, and in commercial, I think it's 39 years. That's the amount of time the IRS gives to useful life of a building, which means you can write off 1/27 of your property value on your taxes every year. So that's really helpful. Any expenses associated with the property, including when you drive to the property, including you had to go pick up supplies, maybe you had to take your contractor out to lunch. Maybe you're getting education to learn how to get better at real estate investments. All these expenses are business expenses that you can write off on your taxes. In addition to that, you can have a business formed that can give you a lot of tax benefits as well, where you can, again, run all your expenses through the property, write off as much as you want to write off. Do be a little bit careful with that, because in the beginning, if you're writing everything off, then you're not going to show any income from your investments. And then that's going to be difficult to get more funding going forward. So in the beginning, we tried to not write too much off so that we could start to show income and show that the business was making money. Because if you're writing everything off, then you're not making any money. But as we went along, we could write off more and more. All right, number five, are there any real estate investment strategies that can generate passive income? Absolutely. There's a lot. And I would think the best one to look at for me, it's gonna be different for everybody, was multifamily. Because if you're looking for cash flow and you've got 2 or 3 or 4 tenants in a property that are paying you rent versus just one, even if their rents are a little bit smaller than you get from a single family, as a whole, you're gonna make more cash flow that way. Typically, single families are better for building long-term wealth appreciation. They're also really good for fixing and flipping. They're not usually the best for cash flow, unless you could do something else with it. Maybe you're in an area that's good for short-term rental. There's other types of ways you can rent out your property that'll get you more than a long-term tenant would. But I really like multifamily investing. How do I decide between residential or commercial real estate investments? It's gonna depend on your goals. You know, I actually don't get into commercial other than technically anything with 5 units or more is considered commercial. So I do own some commercial buildings, but they're apartments. So I don't really know a ton about commercial real estate, to be honest. I think residential is a great place for a lot of people to start, but I think it really just depends on your skill set because you're going to have an unfair advantage in something. You know, maybe that's how well you know your local market. I know a lot of people that got directly into commercial because they worked in that space. They were a commercial real estate broker, or maybe they were doing commercial lending. And so it was a natural progression for them to start getting into commercial real estate. Well, if you don't have any experience in commercial real estate, then maybe it's better for you to start with residential. So I think it just depends on your skill set and what your unfair advantage is in the market. Next question, what are some ways to tell if someone is a scam artist in real estate investments? Does it sound too good to be true? Because it usually is. I would definitely say anybody on social media that it sounds too good to be true. If they're spending more time driving Lamborghinis and Ferraris than doing deals, then that's not real. All the real estate millionaires that I know, that I follow, they don't, drive around in flashy cars actually. Even though they probably could, they usually don't. I tend to think that you either try to talk the talk or you actually walk the walk. You tend to not do both, right? The richest people in real estate, you wouldn't even know it by looking at them. Like they're not going to be all flashy. So I tend to think like the first thing to look for is, are they all about material appearance and looks and fancy things, expensive things? And does it sound too good to be true? What is passive income through investing in real estate investment trusts or REITs? That's a great question. So real estate investment trust, the simplest way to think of it is like a mutual fund for real estate. So instead of having to buy an entire property, you could buy a share of a trust that owns a property. So maybe they own $1 million property and you're like, well, there's no way I could ever buy $1 million property, which I would challenge you on. I think you could definitely do that, but that's okay. Just go buy a share in the real estate investment trust, which you could buy any amount of shares and you could put as much money or as little money in as you want. And then you own a piece of this company that owns the real estate. You're probably going to make a lot less on your return than if you were investing yourself, but you could also get a piece of bigger and maybe even better real estate investments that you otherwise couldn't get your hands on. Can you give some examples of bad real estate investments? Why were they bad? Yes, from my own personal experience. So we've done a couple Airbnbs and hope to do more in the future. It's not really our forte, so it's not something we're really focused on right now. One of the things I've learned in real estate is to not get shiny object syndrome because there's so many different ways you could go, but it's better to focus on one way that is going to be the best for you. But one of the things we learned with Airbnbs is to not buy in an HOA, especially an HOA that's gated, that controls the rentals in their communities. Because we had that, and what ended up happening was we had to spend an extra $400 per month paying to the HOA to have our short-term rental that we did not calculate up front. We didn't know about up front. And not only that, it was just a pain in the butt. They kept changing the rules every couple months. They made it as difficult as possible for you to rent out your house on Airbnb. So that was an example, I think of, it wasn't an awful, one of the things I love about real estate is you're very rarely going to lose your entire shirt on the investment as long as you're doing your due diligence up front, right? So even though we made some miscalculations in that one, we still actually were able to sell it and break even. I would say we've had some pretty good luck, knock on wood, that there's really nothing we've lost a ton of money on. Early on we got into some single families and we ended up with some that just felt like they were money pits. Again, we broke even on them. We really didn't lose money on them, thankfully, but we just kept sinking money into them. Basically all the cash flow we made from the rental of that single family kept going back into the property because there's just so much maintenance that was needed that there's no way we were ever going to make enough rental income to keep up with all the maintenance on that property. Number 10. This is the final most asked questions I get asked as a real estate investor. What are the benefits of investing in real estate as opposed to stocks? Why is investing in real estate considered riskier than investing in stocks? It's interesting because if you ask someone who owns real estate, they're going to tell you that real estate is the better and safer investment. But if you ask someone who invests in stocks, they're going to tell you that the stock market is the better and safer investment. So I think it depends on who you ask to. And honestly, I have investments in both. So I would say we have maybe 20% of our investments in the stock market and then the other 80% in real estate. You know me for real estate investing. I love real estate investing. I believe in it. One of the powers of real estate investing is just leverage, and leverage in a very calculated risk way. What do I mean by that? Well, you can go and buy a house. If you're going to live in it, less, but if it's an investment, usually 20% down. So I could buy a $100,000 property for 20%, which means I could only put 20 grand in up front. Then if that goes up in value, let's say 5%, that's going up in value 5% of the 100,000. So it would go up to 105. Well, I just gained 5,000 in value on a $20,000 investment. I actually increased my value by 25%. Not only do I get the appreciation, but I get the cash flow, I get the tax write-off, off of the depreciation every year and the business expenses. And I also get any kind of forced depreciation, which means if I put work into the property, I can improve it. If I raise the rents, a lot of times, especially with multifamily, that improves the value of the property. There's just so many ways that you can make money from one real estate investment. And sometimes it's not direct cash in your pocket, but it might be increased value of the asset. It might be tax write-offs and things that you don't get with the stock market. Like, yes, the stock will go up and down in value, and there's a lot of stocks with dividends, but it's hard to find one that has all of those things in it that you can find with real estate. And like I said, with leverage, you could buy an asset worth 5 times what you're putting in. And it's, like I said, it's a very calculated risk. It's a very safe investment compared to a lot riskier investments out there. There's no such thing as a sure thing. Every investment has risks, but to me, real estate's a much more calculated risk to where you can determine where do you want to buy, what type of property do you want to buy, how do you want to fix it up, how do you want to manage it. The big disadvantage is that it is a lot more active. A lot of people think real estate investment as a passive form of investing. Well, the stock market's actually a much more passive form. You buy the stock and then you just sit on it. But I love the fact that I can go in and control my investment by improving the property, improving the tenant and the operations of the property, determining when I want to sell, what I want to do with it. Like, you have much more control. And then, like I said, there's the aspect of leverage. So this has been the 10 most questions asked as me as a real estate investor. I hope you got some value out of it. So thanks for following along, guys. Follow my channel, The Hardy Investor, on Instagram and YouTube to learn more about real estate investing. I'll see you guys in the next video.